highlight and note that even though there is changes coming to the tax beyond $3 million, $3 million is for per individual. So if you have a couple, effectively that's $6 million of untaxed money in retirement that they can still have access to. So that still, again, remains quite effective in a sense that, if you're funding your retirement using super potentially or using a combination of super and other assets, that would probably be one of your most tax effective vehicles in that setting.
Effectively, Derek. And to that point, well, much as figuratively we do have a crystal ball in this office, but I don't have a crystal ball, and may very well next government may change the laws around this. They may very well start lowering this threshold. The tax reforms are a natural byproduct of managing a governing country's monetary issue. So if your strategies need to remain adaptive, they need to remain consistently managed and addressed and studied over time. One of the points that we've probably raised in some of our early discussion has been always about exit strategy. How long do we hold an asset? How do we get out of it? And therefore, again, the average thinking about investing for a lot of doctors conventionally has been, I'm going to go buy a bunch of houses that will save me some tax, and then they will eventually be paid off, and then I'm just going to keep getting rental money from it at best, or at worst, they have assumed that these asset prices would almost always inflate. And there we are, there we have it. We just had negative gearing completely scrapped out. So in a 20-year trajectory, being advised, your strategies may very well change 40 times around asset structuring, investing, moving funds, what's next, what's changed. So unfortunately or fortunately, when you deal with such complex tax regimes and such complex world and universe of investments, you're going to need somebody to counsel to and understand these implications and allow you to structure and regear for some of these changes.